Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein of Linn & Associates with your metals market update for this Monday, the 9th of July, 2018, and we're about 2:05 p.m. Central Daylight Time. It's gotten very quiet in the metals, so I'm comfortable putting out the update as we're right in these areas here. Nothing has really gone on. The stock market has stayed positive literally from the get-go today. We've had a mixed day in the currencies, up, down, sideways. The Brits got hurt as Miss May saw a number of her, I think 2 of her cabinet ministers resign over the current Brexit. 2 of the Tories resigned. She's obviously got her hands full there. We're seeing energy prices still hold up, both in the Brent and the WTI. The grain markets got hit pretty good today, and the question is what's going on, because here we are, we're just past the week of the what? Trade wars with us, China, and there's tit for tat going on. Tonight we're going to get the Supreme Court nominee that the president's going to give us, so we'll see what goes on with that. But in the metals, a bounce, but nothing spectacular. Copper is so overdone, you'd look for it to gain over the other metals if you can get something going. The problem is it a dead cat bounce? Without the trade wars being removed, why is it going to hold? That's the question you ask yourself. When you look at the gold chart on a weekly basis, you've gone from $12.53 down basically $100 an ounce, and you're getting a small bounce. Okay. But this market has done that, if you look at the time frame, at the first part of the year, and it just, once it got under that 18-week average, that's the red line you see right there, it just hasn't looked up. And I use moving averages because they help me understand a neutral point, and then they act as a filter so that my bias is set one way. So many traders, they'll set up for themselves a guide. It could be a relative strength index, an MACD, but they might put other filters on it to make it even what they think is a better trade vehicle. That's what I do. So I have a set of filters. Doesn't mean I'm right, but I have a set of filters. And when the market is under the 18-week average, I basically have a bearish bias. Now, the one thing I can see is a good attempt by this market to bounce, and it all began on this day. This was a number of things. If we come here, and this day was July 3rd, so it's only 6 days ago, you had a key reversal outside day up. What does that mean? Well, an outside day happens when you take out a previous day's low and high. That's the outside. It's up if you close higher. The key reversal occurs when you're at an extreme of a move and that pattern happens. So traders will look at that and they'll say to themselves, okay, if that low's not taken out, maybe the market's gotten excessive. So the market got a little follow through on Thursday, got a little more follow through on Friday, and here we are today, and it's lifted itself, as you can see, nicely up. So traders are going to argue that that could be a break low. When I put on the swing line, this is the same chart, just with the swing line, I now have a low, a higher low, and higher highs. Until you take out the lows of Thursday at 1253.70, the pattern is one, excuse me, higher highs, higher lows. Where might that carry the market? Well, the first thing that I'll put on a chart are moving averages. I have a theory that what I call the line in the sand, the demarcation point on a chart, if you will, is the 18-day average of closes. I'll put it in red. It's right here. That number comes in at 1267 and a fraction. Today's high, 1266.90. So you know, I think we're up at the resistance area of the market. And if it's going to fail, you'll have a pretty quick idea because it'll get under 1253.20 again. The bears, not the bulls, if they want to keep the market into a bearish mode, will try to fight their battle there just the way they fought the battle here. The bulls, if they think this is bottomed, their job is to push the market over that 18-day average so they get the bias turning up, and then they can turn and say we've got higher highs, higher lows. We certainly don't have to worry about the 100-day average. It's far away at 1318. So they'll look at Bollinger Bands. And this Bollinger Band, this top one, this is the bottom. You'll notice first they're not parallel. They're based obviously on an algorithm. That is what they're based on, and you can Google it and you'll find out how it all works. But 95% of the time the market will trade within it. What I've noticed over the years is that as you approach from an extreme like you were here, or back here from this one, you get to that 18-day average and the market tries to figure out what to do next. If that's going to be the case, these bands are going to quickly, I mean quickly, get very close to the market. We'll see if that happens or not. In terms of momentum, the momentum is turned up. Now, a couple of things to understand. Momentum, the way that I teach it in my charting course, and you go to our website, www.iraepstein.com, go under education, you can learn about the whole course and how it works, and believe me, it's a good time in the summer to take it. It's all videos, and I think you'll get an explanation. This is when momentum has converted from oversold to locking in a trend. If you believe, as I do, that price often leads, that rather momentum leads price, price follows momentum, as long as it's embedded, both numbers staying under 20 are fine. But if you take a look this day, you got to 2103, and that day was July 5th, Thursday. That to me implies, I want to use the word implies, that price and the 18-day average are going to come together. Could I be wrong? Of course. I'm looking for the probability, though. That doesn't mean the market's going to shoot up. I'm looking for price to get up to that resistance. You can see this was Friday's action, and you can see that the market's making that attempt. When you come to GLD, it's the same thing. You've lost first. You lost on Friday, that momentum. If I come back a day before, you actually lost it on Thursday. So I think the smart money that follows this type of thinking the way that I do, doesn't mean they do, that's a cover my short idea. Market's letting you out, and today the market's lifting itself back up. Has it converted itself to being all bullish? No. You've got the trend up because you got higher highs, higher lows, but you're not over that key number, the 18-day average. That number's 119.90. You missed it today so far by about 18 points. I would not be surprised that it drops tonight and maybe price and that come together. The stronger of the markets was GDX. Now, if we come back and what I teach is that the first time you hit a Bollinger Band, be it on the bottom, top, whatever it might be, that's where I think the pros are coming out of positions. That doesn't mean that they're taking off everything. I mean, this is GDX. They may have bought 100 shares. I don't know what they bought, but if you get up to it, that's what I'm expecting. So on Thursday, you make a run. If you take a look, 2274 to 2277, haven't quite hit it. Friday, you get up to 2280 to 2278. That's where I think the pros took some money off the table. Is there anything bearish on the chart? No. You've got the higher lows, higher highs. You got an uptrend. You have a market where both the 18 and the 100-day average, they've been kissing each other. They're trying to figure out what to do, but you're also in an overbought condition. So that's what I think they did. Today you get what's called, you could even call it for a short term, a key reversal. You made the highest high off this, came down. Now, if there's follow-through, it's right here that you look to see support. Something else happened. You had a bullish crossover in the market, even though, well, actually it isn't. It's still trading. So if it's going to be down 2 cents, both numbers, the 18 and the 100, are together. If it's down 1 cent, you're going to get the red number over the green. We just saw it happen, I think. So maybe I saw something, but that's what I'm looking at. That's your support number. You don't want to get under 21.98, but you are overbought, and I think the smart money was coming out of the market. Now, I'm also looking at the gold-silver ratio. And the ratio peaked out before in the 82 level. It's recently come up here into the high 78s, and it's running out of steam. From everything I've been around, and it's a lot of years, it's 15 50 years that I've been in this game almost. I'm trying to think myself. I started in '69, so I'm getting just about there, almost. As I look at what this market is doing, to get a bull market in metals, you often have this ratio down, not up. And when you get a high ratio like that, I just don't often see a bull market coming with it. I'm just giving you experience, doesn't mean I'm right. You lost the bearishness in the silver. If you take a look at Friday, you had a 22 reading. Prior to that, you got your embedded reading. Market loses it. You know what I'm going to say. When you lose an embedded reading, yes, you can get it back the very next day. You've got to make that drive down immediately. Otherwise, the odds favor price and the 18-day average are going to make a run at each other. That's where you're at right now. You're also out of your downtrend. Even if you got through 1598.5, you're not back in a downtrend. Or, and by the way, you can't re-embed the stochastic either. So, the odds favor that price and the 18-day average could make a run at each other. In the copper market, you're lifting yourself tonight. You're almost at the highs of the day, but you're still embedded. Until that embedded reading is lost, you got to be careful. Yeah, yes, I think the pros are waiting to sell the rallies, and that's what they're doing. If they see this red number get over the 20 level, I think they'll get nervous. We'll see what happens. By the way, I think I have that one done wrong because all the others, I've got these colors reversed. I'll fix them for you. It's the blue number in this case. I just noticed that. I try to keep all the numbers and colors together for you. In the platinum, higher lows, higher highs. Back here, this was what I like. You lost the embedded reading here. Now, the odds favor, price and the 18-day average are going to make a run at each other. There's Thursday, Friday, today. Any way I cut it, that signal has helped you if you were short at that point. If you take a look at palladium, here's Thursday's action, Friday's. Now I'm looking for price and the 18-day average to come together. That's the idea, all right? Also, if they do, you're going to lose your downtrend, which you did in this particular case. And in the dollar index, if we knew nothing else, and we're back here last Wednesday, if the market closes under the 18-day average and stays in this downtrend, where might it head? Well, we'll argue that the resistance should be the 18-day average. You break this pattern if you take out 94.88.5, this high I'm pointing to, and the objective is the lower Bollinger Band. You go knocking on down on this day, Friday. You hit that number. That's where I think the pros, the first test, with an oversold condition, are taking some money off the table, and this is what you're getting today. That's how you work with it. I talk about a lot of this and write about it in my market research. And the beauty of the research is, in the morning, I think that probably one of the best things for clients that are traders isn't just the commentary, because I give you a whole different point of view on the commentary. It's what I do with the video. I do a special video for those that want to get commentary with trade recommendations. A lot of people just buy my commentary now, and I love that. And it's inexpensive, $240 a year, and you'll find it well worth it. I think it's time and value because I save you so much reading and highlight so many of the points for the next day's trading. Do I catch everything? No. I catch as much as I think is important to you and write quite a bit about it. My writing will look something along this manner. It's not meant to be full-scale reports, pages on pages. It's meant to be the highlights. What are we looking for? What's the event tomorrow to be looking at? And then you get my audio commentaries. Daily numbers, if you're a trader, goes with the other part. And my daily videos. In the videos, I'm able to go through 40 charts at a time and set you up for the morning trade, at least from my perspective. How do you get a free trial to it if you haven't tried it? Call us, go to our website, sign up there. You can click up here if you're watching us on YouTube. I'm Ira Epstein. I think it's going to be an interesting day tomorrow. Let's see if these metals have anything in store. A Monday up, is it going to be a Tuesday down? Take care.